What I have here, MMTs, 2/19/2011, expiration ended Friday yesterday. What we're looking at is imbalance ratios. And we use our SMF market maker platform. What I will say is we're looking at the 1340 call on the S&P. Now, granted, that S&P closed at 1343, and they're right at the strike prices, folks, close to it on the S&P 500. The thing that you're going to learn here, that these were $4 a contract back on 131. The low was $4, and they've ran $16 to the upside, up and out of the money. What you're going to learn here is how we will start to build some short positions on the S&P 500 index. The most thing that you want to know here, there was 29,000 bearish put options bought at the 1340 put on Friday. Big money believes that we have a correction, or they wouldn't be there with that kind of volume. Previous, there was only 7,800. That's 3 times the average daily open interest in one day. That is huge. MMTs. That's where the big money is, because there's not that much traded when they wrote these contracts on the S&P. We're at a deflated area. We could go down to $13 or $12 even and then buy them. But the focus is why will this come down in value? This is inflated up here. They've made a great move. Just like equity prices, option prices get inflated. They made their move, then they correct. They will correct. And the S&P 500 on the daily and monthly charts are overbought. So this has a correction. Once again, they're both going to make a move. We can get an inflated, means you can get a little bit more inflated. However, we're looking at the put side of the market. On Friday, yesterday, on the options expiration, as far as the call goes, there was a certain amount of contracts traded. Here, you can clearly see, whoever's rocking their chair in the background, is that there was a 29,384 contracts traded Friday of the call. The bull is bull still. However, the bear is very bear at the 1340 put. This column here, this column here. This is inflated. This so far has very little trading activity on it. All of the trading activity really came on the put side on Friday, 3 times the volume. Whereas down here, when we look at the volume, the open interest was already 22,000. So you can see you got double the amount of calls to the upside in this inflated area versus the minority side, the imbalance side between the two instruments, is you only got 7,800 here and there. So there's an imbalance. That means that S&P bull believes that we're going a lot higher. However, when we get too inflated at certain strike prices on indexes, this is overvalued, this is undervalued. When the S&P shows on a daily chart that it starts a correction, we're going to look for entries below the market here. We're going to see how this tops out and starts to reverse, and this would be the side of the trade that we would take.